are prepared to break the silence. I'll be out in the sunshine, running beside the lions. I've been feeling down, but I've been looking up.
Hello, welcome back to WINFXTRADING YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. If this is your first time of visiting my YouTube channel, do your best to subscribe and turn on the bell notification so you get notified each time I upload a new content. And try to like and share this channel to your network so that YouTube will push us to a high level of audience. In today's video, there is something very crucial, and a lot of traders don't know about this, and it's more mathematical and very powerful too to getting huge opportunity in the Forex synthetic market. I mean massive risk reward. So here we analyze the market in frequency domain using line charts and then validate the signal using candlestick chart. Here we consider the following terminologies. We shall be considering the following terminologies: equilibrium or range state, path function, smoothness of path function, breakout state, input PIP and output PIP. So these are the things we shall be using in this analysis, and each time I call out any of these terms, I'm going to explain what it means. Okay, so we don't have much time to waste, and I will be going straight to chart to start bringing this terminology and explaining it, and then do the overall summary of this topic and see how it can be applied in real life trading. Okay, this actually works well. Like, for this strategy to work, for this idea to become practical and profitable, you have to deploy it in the daily to the monthly time frame. You have to deploy it in the daily to the monthly time frame. So you need to rotate your screen and go to line chart. Select the time frame of interest. So I will start with daily time frame. The higher the time frame, the stronger the signal. Okay, we are going to run daily, and then we go to weekly and monthly. We're also going to apply this on the synthetic market. So I will start with those terminologies and apply them for real on this chart. Now you identify an equilibrium state in the market. First of all, identify an equilibrium state in the market. Okay, the size, the area or the surface of the equilibrium state also affects the output signal, but selecting the right equilibrium state or range is very important. Marking your range, knowing your range or equilibrium state is very important. So most time, some of this range or equilibrium state can be along a straight line, can be along the path, or it could just be a rectangular stuff. Now let me explain this, because this is elementary, but I'm trying as much as I can to explain everything. This is what we call path function. From this point, from a swing to another swing. So once the length is obvious, or once the length is bigger than other length in the vicinity. So if we measure from here to here, so the length is pretty much bigger than this to here, this to here, this to here. So this is a path function. Okay, so this is also another path function. From here to here is a path function, because if you measure the distance from here to here, you can see that this one from here to here is bigger. Okay, is at least 3 times bigger than the other distances within the vicinity. So that is what we call paths. Once a path is defined, then you have to consider the range. Okay, so the range can be very small or a very large rectangular, price pattern or other kind of patterns. So you have to, in fact, patterns are this range. So we have different type of pattern: rectangular pattern, we have triangular patterns, and then we have wedge, pennants, and other kind of patterns. You have to identify those patterns and mark them. Very, very important. So for tiny range or small equilibrium state is more of a kind of point or a kind of small area, but for a big range or equilibrium state is more of a very large rectangle. An example of a big range is this. You can label this as a big range. Okay, so this is a big range. Okay, so trading a big range have a criteria of trading it. Okay, so I'm going to touch every part of this, both how to trade small range and big range. Okay, so this is a big range, and then this is a tiny range. Okay, tiny range mostly occur along the path function, like the impact, that just impacts range or equilibrium state, while big equilibrium states or range, they are just out of path or a kind of the like multi-path range, because they connect different paths. If you look what is happening inside this rectangle, you see that there is a lot of ups and down movements, different shapes and of different amplitudes, like maximum heights and minimum, like the maximum price and minimum price, and then a lot of zigzags. So inside the range, the market is considered in a state of equilibrium. Okay, so the price action or the path function before the range is called the input, and the anticipated price function after the range is called the output pips. Okay, so our aim is to consider the range and consider the input pip, and then use the inputs to operate on the range in order to get the output pip, and the signal is just the output pip. That is the signal. But before this signal can be validated, we need to take a very strong look in what is happening in the range state of that market. Okay, so if the size of the range is so big compared to the input signal or input pips, then the output signal is going to be a kind of noisy and weak, or it will exist but it can be slow, or the size of the pip, like the total length, could be smaller. But if the range is tiny, and if the range is a kind of small range, then the output might be very aggressive and it could create more distances. But the truth is, the output length of the signal, the output length, which means the pip generated, is not actually dependent on the nature of the range. But what happens is that the range affects the momentum and the volatility of the output signal. So for a very small range, the volatility and the magnitude and the momentum of the output signal is going to be massive, and for a very large range is going to be weak. It's going to be a kind of weaker, okay, because it seems that the markets have exhausted a lot of energy inside the range, and so the output will experience a lot of delay before reaching certain distances. It will reach certain distances definitely, but it's going to take some time before it will actually reach there. Okay, so I don't want to talk much on this because it may not be much more important to other components of this topic. There are major things, and these are the things I'm gonna bring in right now. So when you study the range, if it is a large range, you wait for a path function to start creating outside that range. Okay, when you wait for a path function to create, an example, we have a path function that creates outside this range from here to here. So we have a path function from here. It started from here, and then it moves up. Now the next thing is to validate if this path function is going to hold. How do you know if it is going to hold? Now, before you find the answer to this question, first of all, measure the input pips. Very important. When you measure the input pip, okay, so the input pip, you measure it from a swing to the boundary of the range. So this is around 184 points or 1840 pips. Okay, now you measure the range length. The range length is over 2600 pips. So you can see that the range is a kind of stronger than the input. Okay, the range is a kind of stronger than the input. So this matters a lot. So if the range is a kind of stronger, like the range has much length than the input length, what it means is that it doesn't actually reduce the output length anyway, but the probability of generating a real signal from this range is going to be more of chaos, because it sees that most of the activities are inside this range, because the input is now weaker than the range. So what you need to do is to study every path function that is coming out of this range. How do you study it? You have to study the source of those paths and see their strength. So we have this path that's come up here. It started from here. Okay, now when you have a path like this, and then this is a sign of strength, like the breakout of the range is a sign of strength. Now what you need to wait is to look for a strong support, because the market is actually going up, right? So you look for a strong support. Okay, so we will have this trend. We already have this point here, and we have this point, and then we have this point. Okay, so what you need to do is to wait for price to come back to this trend line, which it did. When it come back, you are looking for curvature. When you see a curvature, that is a sign of continuation. Then you can enter this trade from there and continue the movement. So you have actually created a rare path function. But if you didn't follow it like this, the first path function is going to be a fake. Why? simply because the market is in a big range. So you will meet chaotic probabilistic event that seems to be real, but at the end it will be fail. In other words, you really need to look for their source and try to pick up the movement from that source, and that is what you do with resistance and support. So we use support because we are actually looking for a buy signal. Okay, so that is our range, the big range analysis. Okay, another thing you need to do inside this big range is to actually consider the candlestick chart. When you consider the candlestick chart, you see that we have this day opening and closing outside the range, so we expect a drop. We expect a drop, like we expect a retest. Now, when a retest happens, what you need to look for is change of trend. Okay, so you can get that change of trend at other lower time frame like M30 and then be able to meet up with this. Now we are going back to tiny range. I pretty much like identifying tiny range in the market. Most of these tiny range are very powerful, and you can get them inside big range. You can pretty much get them inside big range. You can get them outside the big range. Okay, so here we can identify this loop. This is a loop, or this is a tiny range. Okay, because the size of this range is very small, or a kind of negligible compared to the path length. So we have an input of 1750 pips reacting or being sent. This is being sent. This is being sent to this range or equilibrium state. So it's being sent to this range. Okay. So for you to get an output signal, you need to wait for a path to start creating outside this range. When the path start creating, like starting length, the length have to be visible. At least if you can measure the midpoint of this range, very important, then you can expect price to move by that midpoint. So the midpoint of this range is around 240 pips, and so if price from the boundary of the range, price start going by 240, 240 pips, which is around here, you see we have a finite distance that actually this path function have started. Okay, actually this strategy is for big investor because it's going to cost you a lot of stop loss for you to actually position for this, for you to make a trade. Okay, so what you basically need to do is to enter the trade once you notice the output path, and then place your stop loss in the opposite boundary of the range. This is the opposite boundary of the range. So it's going to cost you over 700 pips, but you are now generating over 3,000 pips. Okay, that is a massive risk reward. You are basically risking 70 pips to get 3,000 pips. That is over 1:4 risk reward, and this is very powerful. This is for long-term traders. Okay, this is for long-term traders, and you can also validate, like you have to validate this signal in the candlestick domain. When you go to candlestick domain, what do you notice? You notice that we have M. This is M structure, and market is breaking the M structure. So you can enter. That's a sign of continuation. Then you can enter this market and hold it long. The reason why you should hold it long is because we are trading with a frequency domain whereby time does not matter. What matters is the cyclic nature of the market. You are no longer considering time, you are considering the cyclic nature of the market, because you believe that this is output whose energy content is going to be proportional to the input. Because if you go back to the frequency domain line chart, the output is 1706 pips. So you have to expect an input that is K times, like the output should be greater than the input by some factor. So you can use a factor of 2. So if we have an input length of 1560 pips, you expect an output length of close to 3000 pips, and that is basically what gold is doing. Okay, that is very powerful. We're gonna take this to synthetic market, as we are taking almost 20 minutes. So we're gonna go to synthetic market and start working on this. Right now we are going to consider the weekly time frame. Remember, we just did the daily time frame on the 𝑠AR/USD, the Forex market. So we'll be on the weekly time frame, and then we can also consider volatility 75 index on the monthly time frame and see how this can help us. Very, very important. So first of all, you define the type of range you are looking for. I prefer tiny range because not only that they produce high risk reward signal, but their signals are very, very fast. They move with high speed. So I'll be considering a tiny range. So I'm trying to find a tiny range, because a tiny range must be along the path. It must be along the path signal. Path function. So I have a tiny range here. There is a tiny, because you see a bend, so that is a range state. So we have a bend. There is a bend here. Okay, that is a range state. So what I need is to measure the midpoint of this range. Okay, is over 720 pips, and I want an output path function to exist with that size of pips. So that is 720. When I notice that, I'm sure that this market is ready to move. So 720. Okay, so around 15725, 15725, 15725. Okay, we can just put it at 15270. You know, it could be approximately the same. So when you have this is the output signal is ready. Okay, so measure the length of the input part, the length of the inputs, the length of the input part or signal. So we have the length is around the 13,000 plus pips. So we expect the output to be more than 13,000. Okay, to be more than 13,000. It could be 13,000 or more, like either greater than the input or equal to input. Okay, and so what happened, we were able to generate, as simple as that, we were able to generate, this is basically over, we're able to generate over 14,000 pips. This is for long-term traders. This idea is for long-term traders, not for short-term traders. Okay, also for stacking, because you can still reinvest your profit using the same idea. Okay, so basically let's assume you have basically you have placed, let's say you place let's say you have big equity and you have already placed 10 lot size here, you have placed 10 lot size here, and then the market create another range. Okay, we have another range in the week. You don't need to move down to any other time frame. You have to focus on that time frame, get the signal on that time frame, and run your risk management on that time frame. Okay, so everything is being done on this weekly time frame. The only thing you can do is to check the candlestick domain and see if there are rejections or fake outs, and then be able to work them and know what you're doing. So right here, this is another range. So if you use 10 lot size on this price, by the time market reach here, you have made $67,000. When you have made $67,000, you are going to reinvest the $7,000 plus your previous risk. Okay, let's assume before you just risk a couple of, because the risk reward, basically you are entering this market here and you're placing your 𝒓𝒊 somewhere here. Okay, so the risk reward is okay, because you have to be serious with this. You are risking because the higher the time frame, the higher the risk, but the stronger the signal. So you are risking because it should be above the boundary. You are risking 2,700 pips to get you are risking this to basically get over 6,000 pips. So the risk reward is basically more than 1:2. Okay, so maybe you're a big investor and initially you started with maybe you started with $30,000 account, and okay, you have, let's say you have a $50,000 account and you risk $30,000, and then you are now generating over $67,000. Now what you need to do is you have to add the $30,000 previous risk to this $67,000, which is now giving you $97,000. Then when you have done this, you are going to reinvest the $97,000 at this range, putting your 𝒓𝒊 outside because everything is risk. Put your 𝒓𝒊 outside. Basically, you'll be, this time around, you'll be risking 1,000 pips, and then you'll be targeting more than 1,000 pips. Okay, and not even the risk you are using as a criteria for output. No, you are using the input. So the input here will have 8,000 pips. So you want to generate more than 8,000 pips. Okay, so that is basically, but it seems that the signal started to weaken, or at least we can get something reasonable. So that is crazy. By the time you invest, you are going to come up with, you'll be much better than a trader that is trading every day, and he will make some profit and he will lose. I'm trying to call the attention of you as a trader that with this idea, you can just place one trade in a year, and then manage that one trade in that year. Just 1 year, just one trade per year. But you're gonna manage it, or one trade per 2 years, one trade per 3 years. You're gonna manage that trade by reinvesting the profit and using the input-output strategy. Okay, that's crazy. So basically, we shall be going to 𝑽𝑗𝑳𝑚𝒂 index, and we shall be working this on the monthly time frame. Okay, and in this case, I'll just consider any range that is available, any range. I will consider two range. I will consider the big range, and I'll consider tiny range. So a big range will be a kind of surface. Then I have this. I'm waiting for price to leave this range, and for this to be realistic, I need to consider the source of the breakout, the source of the breakout, that is the source. And then what I need is basically, if as like I need to test the strength of this output, this initial output. I need to test the strength of this. It's very important. So what I need to do is to go to candlestick domain. So I discovered there is open and closing monthly candle. We have a candle that open and close in the month outside the range. That is a sign of strength. And now I will now be in this candlestick domain. I'll wait for an enter, like for candlestick to react inside this range, and that's what happened. And I need to see a rejection. I'll start placing my trade. I'll make sure the SL is basically above those rejection. So I'll be risking over 100,000 pips, and then I'll go back to the domain, frequency domain. What will determine my output signal length? I'll measure the length of the range. Very important, measure the length of the range. Okay, you know, there is no input to the range. The range has a zero input, meaning that the range is very, very strong. And so we use this range, okay, as a criteria to measure the output. So we have over 385 pips, so we expect the output to give us at least over 385 pips, and that's what happened. So I could have been bringing the issue of transfer function, which is the ratio of the input, which is the ratio of the output to input, but that is a kind of complicated stuff, a kind of advanced stuff. I'm not going to bring it here. But when the input is 0 but a range exists, it shows that the signal that the range is going to produce is likely going to be very strong. Okay, but the truth is that most of these things you need to consider reversals and continuity. It is very hard to actually say that an input is 0. It's very hard to say that because we have an input from here. So we have an input from here. So the input was in upward direction. So the input is from here, and then it has a size of 154,000 pips, and then after that input a range state creates, and then the output is a reversal. The output is in opposite direction to the inputs. So that is crazy. Okay, so I don't want to go deep, but that is by the way. Right now, let's consider a path function or a path range. So we have this range. Okay, we have this range. This is a range. Okay, and then we are looking for, because this is a tiny range, and so we consider the midpoint theory. And here we have the midpoint is 51,000 pips, and then we want the market to generate around 51,000 pips somehow. We have, yes, they have generated around 51,000 pips. Okay, so now it have generated 51,000 pips. We are going to enter somewhere here because we have already confirmed that it is moving. The SL pip will be around 134 pips. Okay, that's for risk management. Now we need the input length, which is around 300,000 pips, and then we now expect an output of over 320 pips, and that is what we are heading to. Yeah, that is what we are basically heading to. Okay, it is approximately the same. So if we have an output whose length is equal to the input, it is basically okay. But most time the target is 1 times the input. Like the target is times 1 times 2. Okay, if you get times 1 times 2 or more, that's crazy. You can trade your SL and hold the trade for years, you know, and then it's left for you to decide when to come out of that trade. Maybe basically if a range of opposite polarity, a range that creates a reversal signal, and then you close that trade. Okay, an example is let's assume that this range, instead of producing a continuity signal, it creates a reversal. Then you can start taking your profit. That is a sign of change in direction. Okay, so that's crazy, man. That's crazy. Yeah, but make sure you go to candlestick to confirm certain things. Take for instance, if I go to candlestick domain, you discover that here we have a breakout. Yes, that is a sign of strength. A candle close outside the range. So what we need is a kind of pullback to this range. We can extend this range. So most time you may not be able to have patience because you are using a stop loss. You are not going to be taken out. You are using a good risk management. So you are entering somewhere here and your SL is outside the range, basically outside the range. So your SL can be here, can be here, can be anywhere outside the range. Or if you waited for re-enter of market inside this range, maybe you are entering here and then your SL is outside the range. You can see that you are getting more risk reward. Okay, that's power of this strategy. You see, this is very crazy. If you find this video good, if you find this video educative, what you need to do right here is to share it to your network so that they will subscribe to this channel to get more value like this, because basically anybody that watch this video is automatically a millionaire. The reason why you are automatically a millionaire is because if you start applying this idea, and you optimize your risk management to generate high risk reward, you basically can actually enter this trade somewhere here and generate over 400,000 pips while you risk around 30,000 pips. Now if you check the risk reward, is basically you have a risk reward of over 100, like 1:100. So if you have a $1,000 account, for instance, and you go full margin, you see that there is probability of that your $1,000 generating $100,000 profit. But at certain point, by deploying reinvestment strategy, at certain point, if you can discover another range like this one, you can reinvest everything. Before you know it, your equity will accumulate to $1 million. And that's crazy. This is crazy, man. You know, if you want to get a deep insight of this input and output strategy, which is embedded in our courses, synthetic trading course or forex trading course, anyone you want to enroll, you'll be able to learn this more and you'll be able to apply it. But if you feel like you cannot be able to actually do this stuff, or you cannot be able to be that kind of trader that will just want to place one trade, you know, because for you to place one trade and hold long, you must have a big equity, a kind of infinite equity from $100,000 and above. So you need $100,000 and above. But not all traders will have this kind of money. So what you need to do, you have to join our VIP for day trading signals. Where we share, we have categories of groups, and depending on what you trade, you will get at least 2 to 3 short signal, 100% short signal per day. Basically like that, you can accumulate your capital and equity to the level where you can deploy this input output strategy. Okay, thank you. Make sure you keep coming. Make sure you take your trading serious. Bye for now.
You've got it if you're prepared to break the silence.